Ladies and gentlemen, welcome to the Saleri Report. We have a very special treat today. Lucy Komisar, who needs no introduction on the Saleri Report. Lucy is my go-to person for the most complex and difficult financial frauds and shenanigans in the world. Lucy's absolutely brilliant, sharp as a tack, but she's been following financial fraud for decades. A very serious investigative reporter, writer, and somebody who really influences policy, whether you're dealing with tax evasion and tax policy or other issues related to how to manage the financial system. She's also a go to person for policy issues, and she has always extremely popular here. She has a dynamite new investigation. It's one that is going to impact all of us one way or the other, particularly if you have a pension fund or you have insurance policies or annuity policies. So I wanted you to hear about it. Anyway, Lucy, welcome to the Saleri Report. Welcome back to the Saleri Report. And again, thank you for your work and everything you're doing.
I'm very pleased to be here. I know that your audience is a serious one.
They're serious. And I want to bring up, I just want to show everybody Lucy's website. I don't know if you remember this, Lucy, but I remember telling you were going to have to do a website. And you said, no, I'm an investigative reporter. I don't do websites. And now you've got a rich and wonderful website. You've had it for many years. So you can find it at thecommissarScoop.com. The URL is up here. You can see it on the screen share. And it's really an amazing treasure chest because some of your articles on different investigations and tax evasion and the offshore stuff is great. So anyway, but we're going to switch and we're going to talk about your new investigations. You've had two in the series, one last year in September 2022, and then one in December. And let's start, Lucy, by just talking about why did you do this? Tell us why you did this and what you've done.
It happened in a very curious way. I got an email from an insurance fraud investigator, and he said that he knew my work, and he had a story he wanted to tell me. Turned out that I had written in 2004 and 5 several investigative articles about AIG, Goldman Sachs, and their henchmen had set up fake companies in order to scam the people having insurance policies and insurance investments. They had gone offshore and gotten some fake names to pretend that they were really the owners of a company. Goldman Sachs was very involved. AIG was involved. It was very crooked. And that's where I first learned about captives, which is at that time, AIG was using it for a different reason. It set up a captive for a rubber company in Pennsylvania. It charged the owner of the company much more than the real price for, I guess it was workman's comp. And but the money went to a captive in Bermuda, and the guy was able to get a lot of the money back into his pocket without paying any taxes on it. Later, the owner of the company was banned by the SEC from being involved in any public company. So all of these groups, crooked, were involved. And this guy, he remembered me. His name is Tom Gober. And so I got in touch with him, and he said, "You're the only one I can trust on this because the mainstream media ignores this problem." And he began to tell me about two issues. One was about captives, and the other one was about risky investments. And I worked with him for the better part of 2 years because he had many stories to tell, some including famous people like Warren Buffett, who has a story to tell because he was involved in some of this scam operation. He's not in this story. There was too much to write about. So I began to think about how to focus this, and in the end, I took 3 companies to look at. One is Athene, because it is owned by Apollo Global Management, which is the 3rd largest asset management company in the world, run by private equity billionaires. The second was MetLife Insurance Company because it's the biggest U.S. life insurer, and the other was Accordia because it was set up by Goldman Sachs, which last year sold its parent, Global Atlantic, to Kohlberg Kravis Roberts, which is another multi-billion-dollar investment and private equity firm. And Global Atlantic, by the way, is based in the Cayman Islands, where the books are largely closed to the public and the profits are shielded from U.S. taxes. So these companies together have about a sixth of the 1 in 6 of the life insurance policies and annuities written in the U.S. And they're different kinds of ownership. I thought they were worthwhile. Well,
Right.
one of the things they all do after in about 2000, uh, the uh, the state regulators who work through NAIC, which means the National Association of Insurance Companies, which sets the standards for the industry, uh, they increased the amount of money that companies had to hold in their reserves to meet payouts. The companies said these reserves are too high and it ties up too much capital, which we could use, and we don't need the extra reserves. So what they did, they began to operate a fake system, and lax states allowed them to do that. Now these
Now, what
states,
year did the what year
about
did
2000, about
okay
2000.
was
Now
when the
this,
standards changed? Okay.
so the states were, and they came up not all together, but one at a time. Delaware, Vermont, Iowa, um, South Carolina, uh, and see, and Arizona. Okay, what they did was the following: um, you have to captives are, as I explained, how they had been used by the rubber company. You set it up to insure yourself. When
Right.
captives first came on, the NAIC, the regulators, said, but insurance companies can't reinsure themselves. Why do insurance companies need to insure themselves? Because there's something called reinsurance. That is where an insurance company wants to lay off some of the risk. So it goes to some company like Munich Re or Lloyd's of London or even Berkshire Hathaway, and they say, well, you take 20% of our assets and 20% of our liabilities, and therefore, when claims come in, you'll pay 20%. So we won't be hit with the whole amount.
Right.
And so those that's reinsurance. Well, they figured out putting together how are they going to put in less money to cover their liabilities, which is what they were being asked to do. They would set up captives for themselves and they would send it fake assets, and that is what they did in those states. And it's and the NAIC says you can't do this. Does it enforce it? Of course not, because they are controlled by the corporate. It's controlled by the corporations, by the industry. What they did was in those states where books would be kept secret, nobody could see what was in their assets.
Mm-hmm.
Uh, they put reinsurance in these captives in those states, and they filled those captives 1/3 up to 1/3 with letters of credit. Letters of credit are not assets. A letter of credit is, for example, if your company and you have paid for a shipment, you buy a letter of credit from the bank, and it says if the shipment doesn't arrive, uh, you will pay off this amount.
Right.
However, a letter of credit means a loan, has to be paid back eventually with interest, and so but it's a protection that these companies needed, and the letter of credit of the insurance companies in captives might say, if we can't pay off the liabilities because maybe our assets have gone south, uh, we will get this money from the bank, but it has to be paid back with interest. Now,
Right.
how is a loan an asset? A loan is a loan. A loan is not an
Well,
asset.
but
An asset is if you make money on an investment, you have that money, that extra money you've earned,
right,
and you don't have to pay it back to
basically
anybody.
the regulators are saying you can't do this, but they're doing it.
That's right. There's no
Right.
enforcement.
Right.
There's no, so that is what has happened. And what we found out, and I found in all of those three companies, they were all doing it. and they're all pretty much using the 1/3, which seems to be wink, wink, what the NAIC will let them do. So I suppose if they had 100% fake assets, maybe somebody would come in.
So
But
let me just stop you and ask a jurisdiction question. Where are the captives? And then the state that they're using as jurisdiction. So let's say they're using Iowa. Are they
that's where the captives are. The
so they're
captives,
putting the captives in those 5 states. They're not
yes.
moving them offshore.
Well, they also move. That's another part.
Yeah. Right.
There's something else where they move money to they call them captives, and sometimes they just call them reinsurance companies, but they're all the same because they own them. A lot of them are in Bermuda or
Right.
in
So you have a
Cayman Islands.
you have a captive in the US and then you create more captives offshore.
Yeah,
And that
and that
so you've got
also
multiple steps. Right.
nobody can see what's in there. So there's some of the captives are in the U.S. If you look at the books, they actually will say now where uh, their captives are because when they file with the SEC, they have to put in all their subsidiaries, and you
Right.
discover they have a reinsurance subsidiary in Bermuda, and
Right.
they have a reinsurance subsidiary in Vermont,
Right.
and these are filled usually to 1/3, and nobody knows how much is in.
So here's what's important to understand as you're listening to this. If I need to reinsure a portfolio and I move it and let's say I insure it with Lloyd's or Swiss Re, there has to be a market transaction.
Yeah,
They're not going to take bad paper
no,
and
of course
and
not.
and price it over market. They're not going to do that. There's an arm's length transaction that holds it to a level of accountability in that negotiation. If I'm stuffing it into a company I control, then you don't have that discipline and accountability necessarily. So
You have
anything
no
can happen.
accountability.
Right.
And you have no accountability. Up until recently, there was no way to know what was in the captives. For some reason, a number of years ago, the NAIC required companies to file papers saying what was in their captives. And that's when we found out that a third were, well, they called them unadmitted assets. There's a form which
Unadmitted
the top part
assets.
is admitted assets, which generally are stocks and bonds. And there's a whole second part, which are called non-admitted assets. And they actually put this in writing. And what are the non-admitted assets? A lot of them are LOCs, which means
Right. Letter of
letters of
credit.
credit.
Right.
That's the unadmitted assets. They're unadmitted because they're not assets. They're
Right.
loans. It's fake. But they file this. Does any of the regulators say, wait a minute, you filed a paper saying you have fake assets? No, no. They're either controlled in those 5 states. You have to file in every state where people are buying your policy. So
Right.
there are other regulators that will look at this. However, the deal seems to be nobody's going to make trouble for any other state. So if Delaware approves a filing which shows that the company has listed fake assets, another state is not going to make a fuss about it. A number of years ago, it was about 2013, the New York state regulator, together with the California regulator, proposed that these non-assets, not be considered. Nobody got no support from anybody in the country, no support. And both of them, one didn't run again and one was removed from because the
Right.
industry put up somebody against him.
Right.
So when there were any honest regulators, two honest regulators, they
Right.
were quickly removed.
So I want to step back for a second and introduce something that we've discussed, and that is during this period we have seen interest rates come down, 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 down. And I think one of the reasons that happened is there has been an intentional policy to subsidize government and the debt growth model at the cost of many savers. Needless to say, that has put enormous pressure on insurance companies because they're not getting the yield they need to, they priced the contract once upon a time, whether it was an insurance policy or annuity, thinking they could make a certain investment yield. With interest rates cratering, it's pushing them to make riskier and riskier bets to try and make the interest rates you know, so they've been in a squeeze, and they've been in a squeeze as a matter, I would argue, of central bank and government policy, which has kind of put them in the corner. And part of the problem is, you know, it, you then see management like a MetLife doing things that I would argue you shouldn't do But then you also see people like KKR and Apollo coming in, who are literally much more speculative in their approach, who are
Hmm.
willing to play this game.
Yeah,
Right.
yeah, that is true. But it's also one difference is uh, the companies used to be mutuals or fraternals. That is, they were
Right.
cooperatives. They were
Right.
owned by the policyholders. The purpose was not to make money for the CEO and the top
Right.
executives.
Right. Exactly.
It was to take care of the policyholders by making prudent investments.
Right.
And that is the difference. Is so if the problem is you're not making enough money, as long as you have enough assets to cover your liabilities, the payout, the claims, that's all you need. It's
Right.
only when they became for profit, then the question was, our shareholders want more money, and that is the problem. Uh,
Well, but it's not just more money. We're going to use, and we've seen this for a long time in the insurance company. We're going to use this cash flow of paying premiums up front and the payout not coming out to the last minute as cheap capital for our
yeah.
other activities.
Oh, of
So we're
course.
not just going to harvest you for
Yeah.
fees and profits and salaries. We're going to harvest you for cheap capital. So
Oh,
you've
yes.
paid capital assuming a certain risk level. We're going to take much riskier assets and funnel them in, and it's going to make us very competitive because we've got cheap capital.
Yeah, well, McKinsey did a report recently on that, saying that life insurance, the money in life insurance was a great source of capital. And one of the reasons they liked it is because people buy a policy and they may not collect for 30 years.
Right.
So this is capital that is stable there. It's sitting there for you to use, and that is why the whole purpose of life insurance has changed from insuring policyholders in case of a death, or maybe in case of some things might be an annuity that they could get. That is no longer the purpose. The purpose is to make money for the owners, and the owners mostly are. The other part, of course, is the owners, having looked at what happened in 2008, the owners believe that if a company crashes, the government will bail them out,
Right.
because the problem is there may be a million people depending on Athene, a couple of million people depending on MetLife, but they feel that the government will bail them out. So
It's not
they
going to
may.
happen. It's not going to happen. It's not going to happen. So are we ready to talk about the risky investments? Should we go to
Uh,
risky?
we can, unless you want to talk more about how the captives work. I have some example, but we can talk about a risky investments. Okay. Um, Now, there are several kinds of investments which have been analyzed by the Federal Reserve economists, by the Federal Insurance Office economists.
Mm-hmm.
All agree on this. There are three things. One is CLOs, the collateralized
Right.
loan obligations. And remember, at the time of the crash in '08, similar to the mortgage loans, they're bundled together to create debt instruments and cut into tranches. Nobody knows really what's in the tranches. They lie
Right.
about what's in the tranches, and that is how the CLOs work. Then the other point the other way they do this is funding agreements. Funding agreements are actually loans that they are bought by investors. And
Right.
that is, the investor puts money in, and it is really a loan to the company, because when he wants to call it back, the investor can call back the loan, or the loan is only till a certain date. So some
Right.
may be on demand, some may be by a certain date. And if there is a difficulty, financial crisis, they may need to get the money back. But
Right.
the companies don't list them as loans. On their documents, on their filings, they list them as insurance products, as if they were premiums. And if you look under
It's
loan,
not funny. It's not funny.
loan is listed, and some of them, loan is zero. On some of Athene, I've seen papers, they list their loans as zero, but they have these uh,
Right.
funding agreements, which are not loans. Uh, and then there are investments in their own companies, in their subsidiaries.
Right.
Now, if even if you sell bonds.
So it's cheap financing for your business.
Yeah, but look, even
Right.
if you sell bonds, bonds can be marketed, right?
Right.
Bought and sold. Suppose you invest in your own subsidiary, which is in a place where there is secrecy and nobody knows what's really in that
Right. And it's
subsidiary.
not
How
structured
is
as a marketable security. So
how is
there's no
well, who's
liquidity.
going to buy it? Who's going to
Right.
buy it? Who's going to buy a share of a company that is secret and owned by a parent who doesn't give out any information? So this is basically also it's fake. Those are the three kinds of uh, if you look at Athene actually put out on one of its investor documents online their exposure uh, as opposed to other companies, and they had twice as much exposure to asset-backed securities, 21%, uh, which together became three times higher than its peers. Some of them
So
were
if I
twice, some
if I
were
remember
together three
correctly,
times. So therefore, uh, if you also add their commercial asset-backed securities, that made 27%, I found, nearly 50 billion, which over a quarter of its investment were risky assets that are known to face declines in periods of economic stress. So compare this. That was nearly 50 billion in risky assets. Their surplus was 1.27 billion. Uh, it was it was dwarfed. The surplus is the amount of assets over liabilities you have to have until
right.
so you're not ruled insolvent. If they have 50 billion in very risky uh, investments that would decline in an economic downturn, have only 1.27 billion surplus, Athene insurance company is in real danger. That is something that people have to
Well,
know
but
about.
you don't need a decline. You might even just need honest mark to market, honest accounting to wipe that billion out.
Yes.
Right.
Well, yes, yes. If some of those assets are based on the captives, which we know have fake assets. So this is a real problem. And the other MetLife is the same. There was an interesting case uh, because of the the crisis. There was a Dodd-Frank law, and that allowed the Fed Treasury Department to set up uh, a a federal a company that could, an agency that could look at these issues, and it was called the Financial Stability Oversight Council, FSOC. I was saying, kept on saying to people FSOC, and the person on the inside said, no, it's FSOC. FSOC was set up, and it the idea was they would look not just at banks but at other financial type institutions that could have a serious impact on the economy if they were in trouble, and they call them SIFIs, uh, significant oh,
Systemically important
right,
institutions.
right,
Right.
systemically important financial institutions. Well, they said that MetLife was a SIFI. MetLife was doing all the things that we just talked about, having huge numbers of asset backs, uh, their funding agreements. The FSOC said in a report they made FSOC MetLife funding agreements. Uh, they represented 75% of the $50 billion market for funding agreements and funding agreement backed securities issued by US life insurers in the first 6 months of 2013. And that's why it was a systemically important financial institution. Also, they named AIG and Prudential. So MetLife hired Eugene Scalia, son of Supreme Court Justice Antonin Scalia, and he would go on to become Trump's labor secretary. And they said, uh, because the company, the report said the uh, mentioned the captives. Well,
Right.
they said the captives, funded in part by letters of credit, were not dangerous because the companies operated, get this, under a strict state regulatory system. Not really. That non-bank SIFI regulation put it at a disadvantage against its competitors, and that the Financial Stability Council, FSOC, should address risk posed by specific activities, not by an entire company with a lot of activities. The case was brought during the Obama administration, and Judge Rosemary Collyer, President George W. Bush appointee, overturned the designation, saying that MetLife was rejecting that MetLife was systemically important to the financial system, and that said the decision was arbitrary. Now, the FSOC was then chaired by Mnuchin, who
Uh-huh.
was a former Goldman Sachs banker. He did not appeal. And then he also followed her proposal and removed the SIFI designations from AIG, which had contributed to the 2008 financial crisis,
Right.
and Prudential. And he issued new guidelines, basically changing the criteria so it wouldn't be institutions at all.
So I just have to stop you and ask, there is a process under the BIS to determine who and what is systemically important, and it includes insurance companies. Now, what's interesting is if you go to the BIS, they will list who their banks are. It's much easier to figure out who the systemically important banks are than insurance institutions, but insurance is definitely there. Now, here's why I bring this up. There is every indication to believe that some of the sovereign immunities of the BIS are extended to protect these institutions' prosecution. In other words, they have a not fully disclosed immunity to the law, which is quite extraordinary.
Mm-hmm.
So I just bring that up. We'll put that aside, but that kind of situation contributes to a freedom to take advantage of all these different things.
Mm-hmm.
So what we're watching, let me summarize. What we're watching is we're watching a change in policies, whether because we have private equity firms coming in and changing the goal of an insurance company from something that provides a fundamental function to something that is used as capital or made a profit. It's a for-profit model, which is probably inappropriate to that line of activities. And
Yep.
as a result, we have a deterioration in the quality of people's life insurance policies and retirement arrangements that they may not understand or be aware of. Now, I just want to add one other point that I've made to you twice now. I spent about 20 minutes on Athene's website, and I watched a video and I read a series of product descriptions. And I have to tell you, Lucy, I have a degree from Wharton. I was a partner in a Wall Street firm. I worked on Wall Street for 11 years. I was a federal regulator, ran the mortgage insurance funds of the federal government, and I've been in the financial industry one way or another ever since. I spent 10 years as an investment advisor. After 20 minutes, I could not understand a word. I couldn't. I was like, I still don't understand what these people do, other than make me feel warm and fuzzy as a retiree. It was extraordinary, and I just, given everything you're telling me about what's going on, I just can't believe it's not connected. The absence of clarity about what they do and how they do it has to be connected.
And the issue is what should be done. And one of the people I talked to, who is very much involved on a federal level, told me after the SIFI issue, well, we had a new government. It hadn't been appealed by the Trump government. He said that the Biden people are doing nothing about this, and he thinks it's a lack of courage. I would suggest it might be a lack of wanting to make their donors unhappy, but there is no change in the Biden administration from the Trump administration on this kind of regulation. The Banking Committee under Senator Sherrod Brown held a hearing on insurance companies and never mentioned mentioned something about private equity. Senator Warren did, but nothing about captives and nothing about the panoply of risky investments. It was not on their radar at all.
Now, when Warren brought up the dangers of the private equity firms doing what they're doing, and I would mention the private equity firms, in my opinion, can't do what they're doing unless investors back them doing what they're doing.
Mm-hmm.
I mean, the pension fund leadership is complicit in much of what the private equity firms are up to.
Mm-hmm.
And if you look, to me, if you look at the laws of fiduciary obligation, there's no way they should be going along with that. So, if you have any influence over your state pension funds or over corporate pension funds, you ought to be asking serious questions about what's going on with the pension funds money.
Mm-hmm.
But you know, we seem to have a complete inability of the state regulators and the other sort of adults in the room. They have a complete inability to deal with sort of a runaway. How can I describe this? It's a runaway um, implosion of any kind of moral or legal standards.
Yeah,
Right,
that's the case.
right.
That's the case. There are a number of individuals that have tried to speak out on this, but the response in Congress and in the White House is silence.
It's very. I have a wonderful friend who's an insurance broker, and at one point I went to him and I wanted to get a life insurance policy for a client priced out, and he gave me a price both on a life insurance policy and annuity on a company that I would describe as to be excellent in management and credit, very well funded, very high credit, none of this funny business going on. And then he gave me a price on a company that I would describe not as one of the ones you've described, but, on the other side of the spectrum. Things have gotten worse since that. That was about 5 years ago. And the difference in the pricing was extraordinary. And I could see so many people are going to see this unbelievably attractive price and go for it, not realizing, the much more expensive one is real. This other thing is not real. It's a promise.
Mm-hmm.
It's a risky bet that maybe they'll be there and maybe they won't. Anyway, so I'm listening to this and I'm thinking, oh my God, what should I do? So if I have an insurance policy, if I have an annuity, what do I do?
Well, first you get your policy and annuity from a mutual or fraternal that is a not for profit. You do not go to a for profit because the purpose of and of course insurance companies initially were these kinds of cooperatives. So they were
Right,
self-insuring and the policyholders were the owners. And the policyholders' interest is to make sure the company is viable, solvent,
right,
has non-risky investments, real investments, so that it can pay out the claims. That's not
right,
the interest of a for-profit company. That is to make money for its investors and its executives. So if I was buying a policy, I would not buy from any of these investor companies. Now, for example, there's one called New York Life, and it's called New York. It's based in New York, but it sells all over the country. I would buy from them. There's one, there's Northwestern. There are a number of them, but you can
right,
find out whether
right.
or not they are for profit or not. And I would stay away from the for profit, and I don't think you're going to have to pay more on these fraternal or mutuals. That's the first thing that I would do. And I would
So,
also make sure I didn't go to a company that had captives in any of those dicey
right.
fields.
Well, here's the thing. What you want to do is you want to get competitive prices from companies where their promises are worth something in real.
Hmm.
Now, let's go back 20 or 30 years ago. 20 or 30 years ago, there were two players in the market who could help you not only with this problem, but keep the bad actors out. One was called rating agencies and the other was called analysts. And we're now in a world where we can't trust the rating agencies or the analysts. Is that fair to say? And there are no analysts. They're all gone.
Yeah, yes, it is. There was interesting. One of the analysts that gives a lot of A's, to these companies, the ones that I studied, is Fitch. I talked to a guy who was involved in the ratings, and he actually admitted to me that when they look at the assets, they don't count they don't count the fake assets.
Oh, well, good.
They
That's
know the
good.
fake assets, but they still
Right.
give them a good rating.
Why?
The only because then they'll go to some there are about four or five. The only one I found, to be honest, was Weiss, which is a small one,
Right.
and invariably gave a low grade like C's. to the same companies that were getting E's from places like Fitch, so or S&P, Standard and Poor. So if people are looking, they better go to not just the big guys like S&P or Fitch, but a much smaller agency like Weiss. But and that is one help.
So I just
But
want to bring
but
this up
most of them,
on screen
I think,
share
yeah.
again because I want everybody to see this. It's very well presented. Um, so it's up at 100r.org. We'll have links in the commentary. So this is the captives was the first, but then risky business, which we're talking about now, was the second that you brought up in December. Now here's what I want to know because this is, I mean, this is really a blockbuster research and analysis,
Now
and it
that's interesting. What you just passed, that the
yeah
green chart, that shows what Athene invests in compared to what other companies invest in, and they actually put it on their own site, and they're bragging about they have big risky investments. That's where they say our CLOs and this asset backs, and it's like 2 and 3 times as much as what the other companies do, and this was aimed at investors. See, a lot of these things that you're reading are not aimed at policyholders. They
right
are aimed at investors. Investors like the risky buys because they think they'll make more money. If the company goes insolvent, doesn't really matter. Um, there's an interesting point about the funding agreements, which are loans.
mm-hmm
Funding agreements have in them that the uh, the the individuals or the companies making the loans, if there's a problem of bankruptcy, they are pari passu. That means they are first among the equals.
right
Normally, the policyholders would be the first
right
to get any money after a bankruptcy. In these funding agreements, they are on the same level as the policyholders, which cuts the possibility of the policyholders
right
getting very much. So these kinds of deals are made, and the promotion mostly is to investors. If you, there are separate websites. They've got a website for people who who looking for policies, and it tells you how wonderful they are.
right
They've got a website and posts for investors, and that's totally different. They
right
never put the same things on each of the websites. Are totally separate.
right
And the ratings, unfortunately, we found out that the ratings agencies were terrible at the time of rating the investments that led to the crash of 2008. They
right
all these tranches, these mortgage tranches, were getting great ratings, and they were full with garbage. So I don't think the ratings are any better now. So I wouldn't really follow the ratings. You really have to do your own rating, and
right
as I said, you have to be careful about their investments and care and look on the pages for the investors. Forget about the page that's aimed at the policyholders. Look at the page. What are they telling their investors?
so what I've found is they're not common but occasionally you'll find a pretty experienced and sophisticated insurance broker who's honest
Mm-hmm.
and they will steer you to the right places and away from the they know what's going on and they are pretty competent and they will steer you into
Mm-hmm.
the safe companies and you can certainly get a tremendous amount of education in the process of doing due diligence. You still have to do your own due diligence,
Mm-hmm.
but they are experts who can help.
Mm-hmm.
Okay, so I want to go back. You published this in December. It's now 30 to 60 days later. What's been the response?
On an individual basis, a lot of people have read it. They liked it. I've even gotten some response from insurance agents that read it and liked it. Uh, and
So
on,
the companies who are representing the agents who are representing the good companies should
well,
absolutely love this.
yeah. I
Yeah,
mean, I don't know who they represented. Oh, well, I also sent it to a staffer for Senator Elizabeth Warren, who sent me back an email saying, "Thank you. I am sharing this with our team." So I hope that this gets brought up in the next banking committee hearing. That
right.
that deals with insurance because, as I said, they didn't deal with these issues, but they need to deal with these issues, and that will be an indication that the story has some traction. In terms of the the media, did anybody pick it up? Of course not. There were years ago. It was about at the time of when the insurance commissioner in New York was challenging the use of the captives. There was a story in the New York Times about that. There was never again another story about the issue ever. So
Again,
I don't know
right.
why this person who's actually charged, one of her beats is insurance, why there was never another story on this.
So
And
I think if you look at sort of the map of what you're dealing with, I think a lot of people are very afraid of the private equity firms, the big private equity firms. They play rough. It's my experience. I think they're afraid of them. So,
mhm,
I mean, I tell the story. It's not exactly representative, but I tell the story, Carolyn Betts and I, in a piece we wrote called Caveat Emptor, which is what does the deterioration of the federal credit mean to investors? If you're buying treasury bills or bonds, what does it mean to you? And we go through the story of how the Department of Justice went after S&P and almost bankrupted their holding company, McGraw-Hill, and S&P for downgrading the US rating. I mean, if you look at what happened to that company, they were absolutely terrorized. The president of S&P was fired within I think 19 days. So, they basically fired the person responsible and then almost destroyed the holding company with, sort of tangential investigation and litigation. And the message was, you're not allowed to downgrade the United States credit no matter what we do.
mhm.
Right? So, that's a case of the government doing it, but don't think a private equity firm can't bring tremendous pressure to bear. I mean, when I was on Wall Street, I would see them do it. So,
Yeah.
yeah, I just think there's a there's a concept in Steiner that you can never let the 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 justice system be a function of price. In other words, the law is the law, and the people who run the economy should not be allowed to override the law because it makes them money.
Mhm.
And that's where we are. We have a serious governance problem. And you've been tracking and mapping it your whole career.
Yeah.
So let me ask, is there going to be a part 3?
No. Um,
No?
well, because these were the main issues, and the part three would be that what is being done about it. But it's also a problem of being a freelance investigative reporter. I got a grant from the Fund for Investigative Journalism on this, and that came along with support from the Reporters Committee for Freedom of the Press, which has lawyers who vetted
Right.
because you don't want to
Oh, fabulous. Yeah.
trouble with the libel. So everything was vetted numerous times. In fact, every time a change was made, it was vetted. But I don't have money to follow up on
Uh-huh.
what is happening now. So I really can't afford to do it. There are some other things I want to do. One of them is an interesting case where a major bank, which is also a trading company, is it's a specific case, is cheating a has cheated a couple who put money into trades uh, and then was told they just lost the money, but they never, you're supposed to get a confirmation of trade,
Right.
and they never got any confirmations. And based on a lot of investigation they did, they think that this company is first, let me say, most individual traders, retail traders, lose on their trades.
Right.
They think what's happening is that the company is taking the money, is not buying anything, and if they win on any trade, they just take it out of the company pocket and pay them off, but they figure they're going to lose. And because the company refuses to send any proof of trades, they don't know who the
Wow.
counterparty is. Uh, they brought a case in Justice Department's Southern District of New York. It's thrown out for standing. You don't have standing because they happen to be,
What?
well, they happen to be an in the Caribbean, an island in the Caribbean, and but they have also filed with the SEC, and let's see what happens there. And I'm working
But
on this.
was the company that made the trade in New York?
It's an international company. It's all over the world. It has a US
Right,
standing, and a
right,
lot of the things, if it's in dollars, go through New York, because that's the way that the Justice Department has been able to do a lot of cases. If it's in dollars, it goes through New York,
right.
and so the dollars go through New York because and besides everything they're buying supposedly was on a U.S. exchange, and it's very complicated. And I don't want to tell the whole story now because I'm still
Right.
working on it.
Okay.
But the point is, if they did this, would they only do this to this one couple? Well,
Oh, no,
suppose
they would do it to everybody.
so this could be a massive, and this is an international company. It's all over the world. Uh, so that is a very interesting story that could have ramifications, which I'm working on now. Uh, by the way, it's not been sold to anybody. So if there's any editors out there that are interested, let me know.
Well,
I
something
have a
else
lot of
now.
documentation, a lot of document. The next thing, which is related, because I've written several things on this for the American Prospect. I focused on GameStop when that came up as an issue.
Hmm.
But the story, which I had already been working on, was naked short selling, which is a massive corruption of
Massive corruption.
stock
Right.
market. Short selling, is when you're allowed to do this. Maybe you should be or not, shouldn't be. You can sell a stock you don't own. You're supposed to buy it within a couple of days so you can send it to the owner. Usually it goes through the broker who paid for it and doesn't know that you didn't use, if he paid for something that you don't have.
Yeah.
The idea is you think it's going down, you're going to buy it cheaper. So the money that you got for it is going to be more than what you paid for it. But the naked short selling is you don't ever buy
Right.
the stock. You never send it to the seller, but the system gives the seller an entitlement, a digital entitlement. So now can be sold 2 shares. Before there
Right.
was 1 share. This person has an entitlement, can sell it. Never knows that he didn't have anything real. This is allowed. And it's really scandalous because what happens
Right.
is it doubles the number of shares. When you have more shares than you had before, the price goes down because supply and demand, you've got bigger supply, the price goes down. So,
Right.
and this, by the way, was one of the reasons for the Great Depression. And
Right.
uh, they were watering the stock. That's the
Right.
same thing. Papers, they would
Right.
counterfeit
And
papers.
the
They would
watering of
water,
the stock has really been to the advantage of the big Wall Street brokerage firms who do it.
and they're
Right.
doing it. They're still doing it, and that's what naked short selling is. Naked short selling is watering the stock.
Right.
There was a line which may be apocryphal, and maybe somebody was supposed to have said, "He who sells what isn't his'n must pay it back or go to prison." They don't go to prison.
Right.
And Goldman Sachs was had to pay a fine of some millions because they were found guilty of this, of naked short selling. Actually, they were enabling some clients to do naked short selling.
Right. Right.
And but again, I want to do a book on this, and I've been working on this. So if there's a publisher
Oh,
out
a
there
book by
or
you on naked short selling would be
let me know
fantastic.
because this is getting more and more attention, and it will be something that Gary Gensler has to take up because of lawsuits, even that
Okay, so I'm going to do
are happening
screen
now.
share and I'm going back to show your website. If we, over here is a donate button, okay? So one of my favorite quotes is speed costs money. How fast do you want to go? What we need, if we're going to turn around the financial system, and it's going to happen eventually, I just think we need great reporting, and I think great reporting on these two stories would be fantastic. So if you agree, I'm going to do this week, but if you agree, go to Lucy's website at thecommissairescoop.com and click on donate, and don't ever say to me why is nobody doing anything, because Lucy, you are one of my heroes, and
Thank you. And I want to say, if you donate, if you use something like PayPal, list it as family and friends because otherwise they charge a commission. So you should always
okay.
know that when you want to donate to anybody using PayPal, always say it's family and friends, and it's not a business.
Right.
The commission is supposed to be if you're a business using PayPal, but you're not a business. Unfortunately, I'm not a business either. So just
Lucy, you are a force of nature. Oh, okay. Anything else before we close that you want to add?
no. Let's see what happens with the banking committee and with any efforts that are made to rein in these people. But I think unless there is serious federal regulation and a change to the system of bought state regulation, that
Right,
nothing's going to change. So I'm really I try to be the truth teller, but I'm not an organizer. You know, the
right.
Unite Here, the trade union, which has several 100,000 members, they have been very involved. They have on their own website about Apollo and Athene, and
Wow.
they have been involved in trying to get the NAIC, the regulators, to move on this. And they have put out um, statements and letters to the NAIC. So that's one
Good for
group
them.
which is an activist group. It should be more activist. I don't know of any other unions involved, but that's one. So there needs to be some of the people that are looking at the financial system with the goal of fixing
Well, but in the
some of the
meantime,
mistakes.
if you're a consumer of insurance products, life insurance, annuities, what you need to know is there's wide variation in the quality and the trustworthiness of these companies.
Yes.
And you need to be exceptionally careful about which companies you do business with because it's an educated consumer that ultimately is the major enforcer here.
Mm-hmm.
Yep. Okay. Okay, well, Lucy, thank you so much for joining us on the Slayer Report. We're having this up, I think, in 2 or 3 weeks. I'll let you know when it goes up. And I can't thank you enough for doing this investigation. This is a very great contribution. It's going to help a lot of people.
Well, I hope so. Hope so.
Hope so. Okay, have a great day.